Welcome to the Deep Dive, where we cut through the noise on the most important earnings calls.
Today, we're digging into Medtronic, ticker MDT. They just had their Q1 fiscal 26 call on August 19th.
Right. And our mission, as always, is to walk you through what really matters, the financials, the strategy shifts, what management's signaling.
Basically, everything you need to know about where Medtronic is heading.
Let's get into it.
Okay, so what's really interesting right off the bat is Medtronic put up some pretty strong numbers for the quarter ending July 25th.
Yeah, on the surface, looked good, but the market reaction, kind of, maybe even a bit negative.
Exactly. The stock actually dipped. So that's the puzzle, right? Solid results, seemingly, but investors weren't buying it initially. What's going on there?
That's what we need to figure out. So let's lay out those top-line numbers first. Non-GAAP EPS, that came in at $1.26.
Which beat the street by 3 cents. Not bad.
And revenue was $8.58 billion, also a beat by about $200 million.
So beats on both top and bottom lines. Reported revenue growth was, 8.4% year over year?
Yeah, 8.4% reported. Organic growth, which takes out currency and M&A noise, was 4.8%.
Okay, 4.8% organic. Decent.
Mm-hmm.
But clearly not enough to impress the market that day. They were looking deeper.
Precisely. So let's dig into those details. Profitability is always key. How did the margins look?
Right, so the adjusted gross margin landed at 65.1%. Now that was stable compared to the last quarter, Q4.
Okay, stable sequentially.
But it was down 80 basis points compared to the same quarter last year.
Down year over year. Why was that?
Well, it was a few things. They mentioned pricing discipline, which sounds good, but also suggests maybe they couldn't raise prices much. And then business mix headwinds.
Meaning they sold more lower margin stuff?
Exactly. Specifically called out Cardiac Ablation Solutions, likely more capital equipment sales there, and diabetes, partly due to early costs ramping up manufacturing for new products.
The ramp-up costs. Makes sense.
They did have some cost-saving programs helping, COGS efficiency, but that was offset a bit by ramping up production for Affera, their new PFA system.
Got it. So a mixed bag on gross margin. What about operating margin and expenses? Were they keeping costs in check?
Adjusted operating margin was 23.6%, and R&D spending was up 7.7%.
Investing in the pipeline, then? That's usually seen as positive long-term.
Definitely. But on the flip side, they managed SG&A selling, general, and admin costs pretty tightly. SG&A growth was 170 basis points below revenue growth.
So good leverage there, disciplined spending.
Shows cost control, yeah. And the tax rate was a bit better than expected too, 17.8% adjusted. Came down to where they made their profits geographically.
Favorable jurisdictional mix, right?
And foreign exchange turned out to be neutral for EPS in Q1, a bit better than they'd feared.
Okay, so overall financial picture. Solid revenue beat, EPS beat, helped by tax and FX, but some underlying pressure on gross margins offset by cost control and R&D investment.
That's a good summary. But to really get the story, you got to look at the individual businesses. How did the different segments perform?
Right, the segment breakdown. Where was the real strength?
Cardiovascular definitely led the way. Organic growth there was 7.0%.
Strong number for cardio. What drove that?
Primarily Cardiac Ablation Solutions, CAS. That business grew nearly 50%.
Wow.
And in the U.S., it was up an incredible 72%.
Wow, 72% U.S. growth for CAS. That's huge. What's driving that? New tech adoption.
Absolutely. It points to really strong uptake, likely of their newer ablation technologies, including the early Affera rollout. They also saw double-digit growth in cardiac surgery, ICDs, and leadless pacing. Cardio is firing on multiple cylinders.
Okay, cardio is the star. What about diabetes? That's been a big focus, especially with the spin-off plans.
Diabetes also had a strong quarter, actually, up 7.9% organically.
Better than overall company growth.
Yeah, but the story there is really international versus the U.S. International diabetes grew 11%, driven by their sensor tech, Sinclair.
But the U.S.?
U.S. growth was slower. The sense is patients are sort of waiting, holding off maybe for the newer CGM tech that's coming.
The pipeline effect. Waiting for Simplera Sync.
Seems like it. Then neuroscience. That grew 3.1%.
Okay, positive, but maybe not spectacular.
Supported by high single digits in neurosurgery and neuromodulation, which is good. But the overall segment growth was a little below trend. They mentioned some strategic changes, particularly in pelvic health, impacting that.
So maybe some deliberate pruning or shifts there. And the last one, medical surgical, their biggest segment, right?
Yeah, biggest by revenue. It posted the lowest growth 2.4% organic.
Which they said was expected.
Pretty much in line with expectations, yeah.
Yeah.
It faces ongoing sort of stable market pressures, things like bariatric surgery trends, and the general shift to robotics impacting traditional surgical tools in the U.S. More of a steady Eddie segment right now.
Okay, so summing up the segments, cardio leading strongly, diabetes solid internationally, but waiting in the U.S., neuro growing, but maybe some portfolio tweaks happening, and MedSurg steady but slower.
That paints the picture. And it brings us back to management's outlook. CEO Geoff Martha sounded really confident, said they're on the cusp of an acceleration in the second half of the fiscal year.
Right. So despite the current mixed picture and market reaction, they're promising a step up. What are the big catalysts they're banking on?
They highlighted several key drivers. First, that cardiac ablation business, especially Pulse Field Ablation, PFA. The Affera system rollout is going strong.
The one driving that 72% US CAS growth.
Likely a big part of it. And they expect CAS to grow even faster in Q2. Management actually threw out a number. They see an incremental $1 billion in revenue from CAS on top of the FY25 base coming in the near term.
$1 billion incremental. That's a serious bet on PFA and CAS.
It's a huge target. Second big one, renal denervation, RDN. Their Symplicity Spyral system.
For hypertension, right? This has been talked about for years.
Exactly. And the big catalyst is the final CMS coverage decision, the NCD. That's expected by October 8th.
And if that's positive and broad?
Huge potential. Addresses uncontrolled hypertension, a massive patient population. Management thinks this could be one of their biggest product categories ever, a real potential game changer.
Okay, PFA and RDN are massive potential shots on goal. What else for the second half acceleration? Diabetes.
Yeah, diabetes is set to pick up. The U.S. launch of Simplera Sync, their new CGM, is slated for this fall. That should address the slowness we saw in the U.S. market.
And they have another sensor coming too.
Right, the Abbott-based Instinct sensor also coming in the next few months. Plus, the plan to separate the MiniMed pump business is on track.
The two-step IPO and split.
Yep, within about 15 months. They said that separation should be immediately EPS accretive for Medtronic. And they're submitting their next-gen pump, MiniFlex, to the FDA by the end of this fiscal year. Lots happening in diabetes.
And robotics. The Hugo system.
Hugo RES is another key piece. The U.S. launch for urology is expected in the second half of FY26. That's also expected to add to growth.
They're making progress internationally, too.
Yeah, got a CE mark for their Ligature vessel sealing tech integration, and they're presenting data for U.S. hernia approval in September. So robotics is moving forward.
Okay, quite a pipeline hitting in the back half. PFA ramp, potential RDN launch, new CGM sensors, Hugo progress.
Plus some other things like tibial nerve stimulation launches in pelvic health this fall, and the Liberant thrombectomy system in the second half. It's a packed schedule.
So how did all this translate into their updated guidance for the full fiscal year 26?
They kept the organic revenue growth outlook the same, around 5%.
Okay, no change on organic growth expectations.
But they raised the reported revenue guidance to between 6.5% and 6.8%.
Why the raise on reported if organic is flat? Ah, currency.
Exactly. A bigger expected positive foreign exchange tailwind. Now looking at $550 to $650 million benefit from FX.
Gotcha. And EPS guidance?
Also raised. Now $5.60 to $5.66 per share.
And what drove the EPS raise? Just the FX?
Mostly something else, actually. A lower expected headwind from tariffs. They initially thought tariffs might hit them for up to $350 million this year. Now they're expecting it to be much lower, around $185 million.
So a significant chunk of the EPS raise comes from lower tariff costs, not necessarily better underlying operations than previously thought.
That seems to be a big part of it. And maybe that gets us back to the market reaction.
Right. The beat and raise looked good, but maybe investors saw how they got the raise effects, lower tariffs, and weren't as impressed as if it had been purely from faster organic growth or margin expansion.
I think that's exactly the crux of it. Investors wanted to see more operational improvement now. They saw the EPS lift as maybe lower quality, driven by these non-operational factors.
And the fact that the big growth acceleration is still promised for the second half probably didn't help either. Investor impatience.
Could definitely be part of it. It's a show me, don't just tell me kind of situation. Plus, there's the whole Elliott situation.
Ah, yes, Elliott Investment Management, the activist investor. They took a big stake. What came out of that?
Well, it prompted some significant governance changes. Medtronic appointed 2 new independent directors, John Groetelaars and Bill Jellison. Both have serious medtech operational chops.
Bringing in outside expertise.
And they formed 2 new board committees, A growth committee focused on portfolio management, M&A, capital allocation, basically driving faster growth.
Makes sense. And the other?
An operating committee focused on efficiency, cost management, driving margin improvement.
So direct board oversight on both growth and efficiency, likely pushed by Elliott.
That's the read. It signals a clear focus on boosting performance and shareholder value. Management framed it positively, of course, but some investors might have had a more lukewarm reaction. Maybe skepticism about whether these changes will translate quickly enough.
So a lot riding on execution now. Management needs to deliver that second half step up, hit those PFA, RDN, diabetes milestones.
Absolutely. Their credibility is on the line. They need to show these governance changes lead to tangible results sustained better than peer growth. Management talk about a super cycle of innovation and transformational growth drivers. Now they have to prove it.
It's a pivotal moment for them. Okay, let's shift gears slightly. Time for our This Is Not Financial Advice segment. Given everything we've discussed, the pipeline, the skepticism, the catalysts, what are some, let's say, outrageous but plausible hypothetical trade ideas an investor might ponder here?
Right. Purely hypothetical thought experiments. Remember, not recommendations.
Understood. Idea number one.
Okay, how about this? Betting big on the RDN upside with something like a short put ladder.
Explain that. Betting on Symplicity Spyral.
Yeah. The market seems cautious, maybe discounting RDN's potential ahead of that October 8th CMS decision. Public comments on the proposed coverage seemed positive, but the stock isn't fully pressing in a home run, perhaps.
So if the final NCD is broad and adoption takes off faster than expected,
this could become a huge product category fast. Uncontrolled hypertension is massive. The stock could re-rate significantly higher. A short put ladder selling up below the current price, maybe selling another even lower, is essentially a bet that the stock won't collapse and could gain momentum if RDN hits big. It profits if the stock stays flat or goes up with defined risk.
Interesting. A bet against excessive pessimism on RDN. Okay. Outrageous idea number two.
Idea two. Playing the volatility around the investor day next year. A long strangle.
The investor day set for mid-2026. Why play that?
Because that's when they'll lay out the full post-diabetes separation strategy, new long-term targets. With Elliott involved, new board committees focused on M&A and operations. Expectations could be high, or the plans could underwhelm. It feels like a potential inflection point.
So high uncertainty, high potential for a big move.
Exactly. A long strangle involves buying both an out-of-the-money call and an out-of-the-money put, both expiring after the investor day. It doesn't care which way the stock moves, only that it moves a lot.
So if they announce aggressive M&A and killer targets, the call pays off. If the strategy disappoints and the stock tanks, the put pays off.
Precisely. It's a bet on a significant reaction, up or down, driven by that strategic update.
Two very different bold takes on the potential paths for Medtronic. Fascinating hypotheticals.
Again, just thought experiments based on the current dynamics.
Definitely. Okay, let's wrap this up. Key takeaways from Medtronic's Q1 call.
They beat Q1 estimates for revenue and EPS, and they raised the full-year EPS guidance.
But that raise was helped significantly by lower tariff expectations and positive FX, not just core operations.
Right. Management is strongly signaling an acceleration in growth for the second half of the fiscal year, pinning hopes on major catalysts like PFA, RDN, new diabetes tech, and Hugo Robotics.
The arrival of Elliott Investment Management has spurred governance changes, new directors, new committees aimed at sharpening focus on growth and efficiency.
But the market remains somewhat skeptical, waiting for concrete proof of this acceleration and operational improvement. Execution in the coming quarters is absolutely critical.
And remember, everyone, this conversation is purely for informational purposes. It is not financial advice. Always do your own research and consult with a professional.
Indeed. The big question hanging over Medtronic now is whether this truly is the start of a super cycle of innovation, as they claim, or if the path to convincing the market will be longer and bumpier.
We'll be watching closely. Thanks for tuning into the Deep Dive.